Welcome to the OPEX Effect, a joint podcast from Excess Returns and Spot Gamma, where we take a deep dive into the world of options and the flows they generate in the markets. Join Brent Kochuba and Jack Forehand every month on Options Expiration Week as they look at the major developments in the options world and how they impact all of our portfolios.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility.
So Brent, we started this in October, and I've been waiting for my markets and turmoil episode. We've had all this no volatility. I've got my fire for the YouTube cover. I'm going to put it next to you. I got my bright red writing. Like, is it time? Can I finally get my markets and turmoil episode and get it ready to go?
I think we have temporary turmoil, that's for sure. Unfortunately, the Iranian kind of Middle East conflict has escalated, I guess, and we're hoping that cooler heads prevail there. You know, I'm in favor of a peaceful resolution, obviously, with all that. But right now, vol is increasing, and so there's a couple of different reasons for that. I think the geopolitical conflict is just one of them. So we'll dig into that for sure.
Yeah, and also, and to your point, I mean, we obviously, we talk about markets, but there's a lot more important things going on in the world. And as we talk about this stuff, we have to make sure we keep that in context. But also from the perspective of the S&P, like we were just talking before we started, like the S&P is not even down very much. It's when you have these low volatility periods, you tend to react a lot to these types of declines because, I mean, the S&P is, I don't know what it is, but it's not more than 5% off the high, I don't think.
Yeah, it was only a week ago, roughly, that we were flirting with S&P all-time high. And then the market flushed violently. That was 2 Thursdays ago. And interestingly, you and I had recorded this presentation about volatility suppression the day before or 2 days before that Thursday flush where the S&P just kind of went from 5250 and just dropped like a rock all of a sudden. And we've been sort of, that base of support has been wearing away underneath. And so not only do you have the Middle East conflict, you have a lot of rate volatility, which, I don't think is generally a great thing for markets. So, there's a lot of things happening right now. And I think it's easy to assign the narrative to the, unfortunate situation in the Middle East. But the fact is that there's a lot of cross-asset volatility increasing. And I think the theme for this presentation is simply that we had this volatility suppression, these flows where some of it I think is 0 DTE. Some of it is this call overriding that people are flagging. Some of it was just a belief in stable policy that people were, counting on, I think, from the Fed and elsewhere. And you have these hot CPIs, changing rate expectations, et cetera. And that's really starting to cause a lot of shifts under the hood. And I think we're exiting this volatility suppression regime.
So I'm excited to ask you about all this as we dig into it. But before we start, we always like to talk about the OPEX cycle and how it works for people who haven't watched our previous episodes.
Yeah, so we cover this pretty quickly just to get an idea how we look at the markets. And the general idea is we do this at options expiration. By the way, I apologize if there's any background noise on this one, everybody. I'm away from my house, and so my primary position, the place I had secured fell apart. So I'm outside.
People are used to seeing you in a totally different backdrop. This is the first one we've...
OPEX doesn't wait for anybody, so the show must go on. So at any rate, so the way that this works into options expiration, which is of course on Friday, we also have VIX expiration on Wednesday. And what happens is after options expiration, we have a bunch of positions expire, and then the 30-day cycle starts to build positions back. And we build positions around strikes near where the markets are trading. And as positions build, hedging flows associated with those positions also build. And then we hit this kind of crescendo into the week of options expiration, which is incidentally this week. And so what makes this week interesting is we have VIX expiration on Wednesday. I thought that if we didn't have Israel today said they were going to have a response back to the Iranian kind of first. Israel said that they were going to respond today to some Iranian, I guess they sent some missiles over this weekend. And I certainly don't want to get into that, but the market, did drop at that news. And I think barring that, we really would have seen or could have seen a pop. This morning, we opened pretty strong. And the reason I bring that up is because there is a pretty high level of VIX into today, which is Monday. And I think that VIX really could have dropped rather substantially based on the fact that there was a lot of flows that are set to expire on Wednesday, which is VIX expiration. Calls get closed out, puts get closed out, and that could have really lifted markets. I still think that could be in place for the rest of this week. It's just part of this option cycle, and I think is something that's important to understand. So we're going to clear on a lot of positions this week with VIX expiration in this Friday's OPEX, and then we'll obviously shift to May expiration. So that's the cycle of the way that we look at things. As you can see here on this chart, the red X's are expirations. Not every single expiration is important for all stocks, but there are certain expirations that mark significant market lows. You can look at something like March of 2020, for example. We've talked about some other famous ones, December of 2018. And a lot of times in these lows, what happens is big put positions get cleared out. Hedges associated with those put positions also get unwound, and then markets can really rally. And that's why I think you need to understand some of the positional aspects of options expiration and the associated flows.
Yeah, a couple things on that. First, I was looking at the VIX. I was looking at the VIX recently, and it's like higher than I thought it was. I don't pay attention to it day to day as a value investor, but I think it was like over 18 or something like that last time I checked, right?
Yeah, we have a slide that come up a little bit, but to your point, it's really humming. And so the idea here is that if you have VIX calls, and there's a fair amount of VIX calls out there right now. In fact, Friday was the highest VIX options volume ever, but call open interest actually only increased a little bit. And I think what happens in that case is if you have April VIX calls, you weren't expecting those to be all that valuable. And then not only that, the situation is like, look, I can monetize these things. They're going to expire on Wednesday. So yeah, the global geopolitical situation isn't all that great, but I still got to sell these calls on Wednesday, right? They're going to expire. And so you have to balance out like, hey, is tension going to get worse there today and tomorrow? Or am I better off kind of monetizing and rolling these things now? And we saw a lot of rolling on Friday with people taking advantage of that VIX pop to 17. We're around 18 right now, and rolling positions out to May or June as they hedge.
And just on your point about the cycle can be more substantial, right? When you couple it with like some sort of major outside event. Like I was thinking about COVID. You had something going on with an expiration. You also had COVID. Like if geopolitical stuff does pick up here, options could really play a role in some volatility, right?
Yeah, you're 100% right about that. And if you think about, we talked about this in this volatility suppression video that we did, and that there are these reflexive flows, these feedback loops that pick up. And it's not just the 30-day cycle. Sometimes it's an investment sentiment, right? Like, hey, we can buy every dip. We can continue to sell puts, and the Sharpe ratio of shorting puts is incredible. And selling vols is this great thing, for example. And there's call overriding hedges and things like that. And if you want to dig into that, please check out that video. But back to the point, people here are very comfortable buying dips and selling volatility up until last week because they felt very comfortable sort of about the implied Fed put, the path of rates, all these other things. And now what happens, the last time we saw an environment like this at all was the March 23 banking crisis, when we have what we call known unknowns. That's the famous, I think, Donald Rumsfeld quote. But the problem here is that you can't be short vol right now because you're worried about the geopolitical situation, and you also, or that rates may be shifting, right? Now we've gotten rid of rate hikes, and inflation is a problem again. So you have to hedge things that you're concerned about, like war is escalating, right? Conflict is escalating. I know that, but I can't use a zero DT option to hedge that out, right? I got to own a longer dated option. And we're going to show this in a couple of slides later, but that risk, right, is something that you have to own longer dated options at time. And you can't just be short vol against something that is a material risk.
So as we get into your slide here about the zone, one of the things that struck me is I think in previous episodes when we've talked about the zone, we've always either been in it or above it. And now we actually are below it. So what are you thinking about this zone and what it means going forward?
Yeah, we saw, so 5,200 was the level we kept bumping up against last week. 5,100 was support on Friday. That support broke today. As you can see here, this is the size of call gamma in orange and put gamma in blue. 5,000 is a massive strike in the S&P 500. And so we lost that 5,100 support, which in our founders note said, okay, 5,000 is a big long-term level. It's also a big fancy round number. There's a lot of funding positions, we call them, box trades tied to that strike. So that adds a little bit of size to this. But I think there should be some pretty material support at that level, which is coming up kind of hot and heavy as we talk here. So from an options positioning standpoint, we're really watching that as a low. And as you can see, there's very little in the way of puts below here. We don't see, really big bars below that 5,000. And it's a level that, we wrestled with not all that long ago. But it should act as pretty big support going forward. Now, what's going to happen is at options expiration, we're going to lose a fair amount of these positions. And if I go 2 slides ahead, you can see this. This is delta by expiration. And so you can see this is the size of April expiration. It's a fair amount of balance of actually calls and puts. So even though, like you said, April or the last week we're down 2-3%, it's still been pretty bullish month writ large for equities in the context of a pretty bullish year. And so, we haven't yet seen a big buildup in puts. The one thing you can flag here is there are massive positions here in the June quarterly expirations. That's always a big one as we move ahead. But this is a market that I think went from overheated to sort of neutral. It's threatening to get a little riskier. But the context of what we're going to talk about here is really this transition from kind of uber bullishness and shorting vol to having to be a little more tempered in the way that I think you go about trading.
I'm just curious, like these 500 increments of the S&P 500 or of whatever of the SPX here always seem to have like massive interest at them. Is that just the fact that they are like these 500 increments? Does that play a huge role in why that's there?
I think a lot of it is, well, there's a couple of factors to it. I think longer dated positions, the strikes thin out a little bit. So, they tend to be at the more round numbers like that if you're trading, a leap or something. And it's also, I think, just sometimes the law of round numbers. You know what I mean? Like 5,200 is a round number. So, or 5,500, that's the number I'm going with. So that's where I'm going to position, in zero DTE space, when you get into shorter, you see a little more, sometimes they call it dexterity, where people will trade the, 52-35 strike or something instead. So, I think that's just a function of ease of use, basically.
So on your next slide, we've kind of been sliding left here as we've been doing episode after episode. We've been moving a little bit more to this higher volatility, regime.
Yeah. And the link between this is our gamma index, which is the y-axis. And what we do is we measure gamma from yesterday's positions and we project what the forward 1-day volatility is. That's the trading range of the S&P. And as you can see, the more negative gamma we get, or the more we shift into the transition of larger put positions, the more volatility comes into the market. So right now we're, down and around this area, which generally tells us that forward volatility is going to be more elevated. When we get into markets that have a lot of call positions and pure call positions, I like to say, then volatility tends to contract pretty sharply. And so we're now in this regime, obviously, with the VIX's 18-19, where the dealer hedging profile should support larger intraday swings. And again, this is on a forward-looking basis. Now, what will be interesting is April OPEX is going to wipe away a lot of these positions, which in this case may alleviate a little bit of the downside pressure if we continue to kind of move lower. So this could be an interesting time. If we get to 5,000, a bunch of positions expire, we could see a little bit of a relief rally between VIX expiration and OPEX. At least that's how we're going to look at it, assuming, again, that the geopolitical situation doesn't ratchet a whole lot higher.
Yeah, that's interesting because a lot of times in previous episodes, I think when the market was going up, we've talked about like when those positions come off, it introduces the possibility of further downside. But you're seeing it a little bit different here because we're not in a situation where we've run up and like all these calls have a lot of value. So we're in sort of a different situation. Am I interpreting that right?
Yeah, that's right. In this case, we have puts and high volatility. And you need, one of the things I think when you're trading in volatility, particularly if you have shorter dated puts or long calls, you need to actively monetize those positions, right? Because if the VIX is at 25, for example, your VIX calls it infers that your S&P puts will be worth a lot. But if suddenly vol drops like a rock, then your put positions are going to get really crushed, or your VIX calls will really get crushed. So you want to be more actively rolling and adjusting those positions. And I think that oftentimes adds to the vol of vol. In other words, how much volatility is moving, because people have to be so active in adjusting their positions. It's not like you have a situation where I own a call and just let the market drift up over time, right? It's just kind of sleepy summer days, no big deal. This is a lot of activity, a lot of stuff moving, and you're forced to sort of take action. And to that point, we had that record VIX call volume on Friday. So a lot of stuff is adjusting in these types of markets.
So as we move to what moved, what we like to always do before we talk about what potentially might happen going forward is we always like to talk about we said might potentially happen in the past. So here you've got a summary of what we were looking at in our last episode.
Yeah. So in March, we talked a lot about the fact that the call bid was breaking apart. So much of the first quarter of the year was the stock up, ball up, buy chips, semi-sector stocks were just going crazy. And we started to see some signals that was cooling. And with that, we saw these measures that we call dispersion and correlation, which were showing kind of like market breadth, that the only thing that was leading stocks higher at that point, the only thing left, right, to really hang your hat on as an equity investor was certain sectors that were really screaming above the rest of the performance of the broader market, the broader S&P 500. So this was, again, tied to the low market breadth, but basically it was like, look, chips are doing great. Financials at the time were doing great. And then the rest of the market was really kind of lagging quite a bit. And what was interesting about that was volatility was very low. And the last time we had, or in other times, I should say, that we've seen signals like this was during what you could flag as bubbles. And our view at the time was like, look, this is a flag that there's a problem coming. We don't know when it's going to unwind. We need a trigger. At the time, I didn't think it would really start to break apart until the November election, but geopolitics being what they are, and some of these CPI prints being what they are, what's happened now is correlation is spiking up. We're going to show that, and the chip sectors don't really matter like they did. Like no one's talking about NVIDIA when it was all anyway. We could talk about 2 weeks ago. And on that point, the thing that we were looking at as a trigger to really cool off that semi-stock trade or semi-chip stock trade was on 3/18. They call it the GTC event. It's kind of, their NVIDIA con or whatever you want to call it. And there was a huge event volatility. We have a chart of that here. This was the term structure of NVIDIA into that 3/18 event. This cone shows you the average range of the 90 days of term structure for NVIDIA before the event. So you can see how elevated it was. And now this is today's term structure. And you can see that we're pricing way below, right? Where term structure was. So this is vol coming down. The reason that vol is elevated here is for NVIDIA's earnings coming up. But right now, the expectations of NVIDIA being this leader are totally off the people's radars. People are focused on macro events, right? Geopolitics, rates, et cetera. And as a result, correlation is really jacked up. Now, if the situation in the Middle East calms down a little bit and these earnings are blowouts, then maybe, we'll start talking about in May or June OPEX, the chip sector trade. But right now, that trade is dead as everything is about macro.
Yeah, it's interesting. Like the leadership of the market changed even before this decline. You could see like it wasn't the NVIDIA, the big tech leading the market anymore. Like things had kind of broadened out a little bit. And now obviously we got the decline and that, geopolitics will take precedence over everything else probably. But it was interesting to see that before all this happened.
Yeah. And financials were at record highs, meaning XLF, industrials were doing pretty well. Crypto was going bananas. And now, with JP Morgan's earnings were not all that great. Obviously, the rates changing puts a damper on that sector. Bitcoin is hanging in there pretty well at 65 to 70,000. Gold had a massive move. And so, some of this stuff just, again, starts to almost flag that the macro sector or macro influences are starting to matter more, which again speaks to correlation really jumping, which means that all stocks are going to start moving together more in unison now as those macro factors pick up more. And that's really what what we're talking about here today and what matters. One thing I want to note is we talked about the record call volumes, which tied to the skews into March. You can see here in blue were those record call volumes. And this tied to the kind of the peak of the semi-sector, chip sector froth, right? Stock up, all up, just this chase. The chase is over at the moment because of this macro sector. But what I want to show was interesting was Friday was a massive call volume. This is equity call volume in blue. Massive equity call volume day in single stock. So, it speaks to this idea that if we get a little bit of a cooling in the geopolitical tensions and maybe we just get a little more rate clarity, I don't think anyone's expecting a hike at this point until the election, then the dip could get bought pretty violently. It's something that, we all need to consider, particularly with vol so high. If vol collapses, we call it the Vanna kind of lift. If the vol comes down, equities could really rally off that. But people, I think, are still trying to buy dips and stuff.
I'm just curious. We saw like in the wake of 2020, we saw a massive increase in the use of options. Like, has that line continued to go up? Like now, is it still rising? I mean, we see slides with like record call volumes a lot on the podcast. So I'm assuming part of that is also, just the options use is up a lot from where it was.
100%. I mean, S&P index volume is huge. We just had, again, record VIX options volume on Friday. I believe this point right here, November of 2021, was the highest equity call volume we've ever had as a whole. And so, we're really sniffing that still. So I think the pace of increase has slowed off. Maybe we've flattened out a little bit in terms of the options adoption, but it's still a growth industry, certainly. And I think with zero DT and short dated options, people are finding more and unique ways to express their views with options because it's great, risk defined trades that you can set up, and there's a lot of different ways to use it. And I think that the use case is really broadened out with the growth. People have really come to focus on and understand those different use cases.
And do you think that exacerbates like moves both to the up and the downside? Because when we do get these flows, there's a lot more money out there that can create these flows.
Yes, options are leverage, and that's really what it is. And that's why it's great for, us as traders when we want to buy a call, we're making a levered bet, right? That a stock will go up. And so I may spend just a few $100 saying that I think whatever AMD is going to go up. And if AMD goes up and my call goes in the money, then that contract obviously represents, tens of thousands of dollars worth of AMD stock, right? And so, someone has to hedge that position out, and they're required to hedge notionally way more than the couple $100 I spent on buying that actual call, right? And that's the leverage component, and that adds to volatility. It adds to market movement. And so, to your point, anytime you're kind of invoking leverage, it adds to just volatility in the system.
Could it lead to one of the things I've noticed, and this may be completely wrong relative to market history, but in recent years, we've had like these extended periods of very low volatility and then like explosions. Like, do you get that type of profile? Do you see that more as you see more use of options?
Well, yeah. And that's about imbalance, I think, and the most famous example of that was, the Volmageddon in February of 2018, which, if you're going to compare the volatility of this past year, the only year it sort of lines up with is that February of 2018 period. It's not the same in terms of you're getting these short vol ETPs and things that could really make the market just sort of break all of a sudden. But there's a lot of other flows that the market, I think, has extrapolated in the future, meaning that you have call overwriting, you have zeroed ETs, and we assume that the liquidity provided by those flows is omnipresent, right? That it's always going to be there. We extrapolate that in the future. And so I think put selling becomes very popular, buying the dip becomes popular. And then suddenly what happens is the market gets weak and these bigger flows are unlocked because of rates or geopolitics, whatever it may be. And suddenly, there is a cover trade, right? All these people that were counting on the market acting the way it always does suddenly realize that the paradigm is different. They have to cover their trade, and then generally vol pops quite a bit. And I think, that's what we're experiencing now, right? Is the unwinding of a lot of these flows that's leading to higher volatility than we'd expect, given the situation, right? Because look, the situation is bad, but I'm not convinced that this yet should be the reason that the market is like the VIX is at 20, right, or 19 or whatever it is. I think a lot of it is driven by this volatility cover trade.
So on this next slide, you're looking at dispersion, correlation, and vol, and this is a slide we've looked at in other episodes. What's sort of changing in this slide?
Yeah, this is a recap from what we saw in March. And I'm going to show the reason I want to show this is because we talked about this. Apologies for that background noise. We talked about this in March OPEX, and you can see that these measures of correlation were at lows, which tells us that not all stocks are moving in the same direction. This is the charts of dispersion. You can see dispersion is high. And then the comparison is, this is from the S&P Global. They said, look, this reminds us, or they didn't say this reminds us, but what they said in their, in this dispersion literature they put out, that if you look at April of 1999 into 2000, dispersion was extremely high in the market, but the vol stayed flat. And I thought this was just a very interesting thing. They said that basically this is the tech bubble, right? Because tech stocks are ripping and vol's not doing anything else. And so this is a bubbly type environment. And to me, it looked a lot like what we're doing, the type of environment that we have now. And the question is, what would force the cover trade to take place, right? At what point you say, I don't want these chip sector stocks anymore. Correlation is going to go up because I need to sell all my stocks because there's something else happening that suddenly I don't care what stock is going to lead the market because the market's going down, and NVIDIA is not going to NVIDIA is not going to lead us out of this situation right now. And you can't help but look at this geopolitical situation plus rate situation as that event that is maybe causing some of this unwind.
Yeah, these geopolitical things are so challenging, I think, because it's completely unpredictable in terms of what's going to happen. I mean, yes. The options, once something does happen, options are going to play a major role probably in that move, but it could go either way at any time. I mean, it could de-escalate rapidly, it could escalate rapidly, which I think makes it very, very challenging to think about.
It's the known unknown, right? You know that there's conflict. Missiles are flying around, unfortunately. And so you can't sit short vol because you don't know what's going to happen. And, you know, I'm not going to get a geopolitical analysis because, you know, what the heck do I know about this other than, you know, it's a risk. And you have to hedge this out, and you're hedging it out into markets that are at all-time highs. And then again, the rate balls I'm going to show is also very high, which, you know, is not something that you could just brush off. So it's like, how many factors do you want to understand that you just can't sit here short ball and just assuming that markets are going to keep doing what they did for the last 6 months, right? We have a litany of reasons to be cautious here, right? Now, to your point, if everybody shakes hands in the Middle East and says, like, you know, like, let's find a path forward for peace. And then, you know, maybe people can look past the rate thing a little bit for right now. It's the election, then maybe markets recover. I do think that, you know, there are forces at work that want the market to go higher into the elections, as that's a measure of success for how the U.S. is doing. And so, you know, we need to keep that in the back of our minds right now. But, you know, certainly the forefront is worrying about hedging out risk as opposed to, hey, you know, can I catch some upside?
This next slide was one of my favorite in the volatility suppression video we did, because I didn't even know this. Like, thinking about how long we've had since we had a 2% decline, and I'm not watching the S&P while we talk. I mean, we may be having one right now, but when we started, we weren't. But it was just surprising to me how long it's been.
Yeah. Sorry again, I'm trying to land in an airfield. I think if you updated this chart, it was accurate. In other words, this is from our presentation. I just grabbed the screenshot. I still don't think we've had a 2% down day. Today may be the first day. So, you know, you can add another, whatever it is, 10 days or something like this, to this period. What was so fascinating about this is that we also did not have a 2% update. And what was so crazy about that is that if you think about this period, you know, this streak officially broke on 2/22 because of NVIDIA earnings. But if you skip that one day, and I know you're cherry picking, but if you skip that one day, there was still not another 2% update up until when things fell apart. So we have this incredible low volatility period that, you know, is simultaneous. Don't get down moves and we don't get up moves. And I think that maybe some of the market not just fully puking here is still some of these, you know, flows that are supportive of markets, zero DTEs, and call overriding, the gamma provided by call overriding, et cetera. If any of these flows are, you know, curious to you, please watch our presentation there. But what's interesting about this, and I'll just flag it again, is that these periods tended to end, many of them quite violently. So if you look at 2007, that was, you know, right before the GFC started in June of 2007. So that wasn't immediate, but this period, number 2, was Volmageddon. That's how that streak broke. You could find number 7, very bad period, right? Q4 of 2018 was really very ugly. Number 8 was the COVID crash of March. So as soon as we hit OPEX, basically that's what that is. Market just one of the worst drawdowns we've ever had, right? So these periods of real calm can break. And then to the upside, you tend to get your big upside moves after the market has dropped a lot. And that makes sense, right? The market goes down 20% in 3 days. You're probably going to have a 2% up day mixed around in there somewhere, right? So, you know, there's some interesting overlap here, but again, the idea is that there were these forces that were suppressing volatility in a major way.
When you look back to like 2020 with the COVID thing, like what you were seeing in the options flows or in the positioning going into that, is it very different than what you're seeing now? Because I'm just thinking, like, you've got a certain positioning and then you've got a catalyst. At that time it was COVID, and this time maybe or maybe not geopolitical stuff, depending on how it plays out. But is it a very, very different positioning situation now than it was then?
I think that there was a lot more. I mean, there's a lot of leverage back then. And, you know, look, COVID obviously was forced the unwind of a lot of trades for a lot of reasons we understand. Was the volatility of that period made worse by leverage in the system? You know, there's all these basis trades that were blowing out and people unwinding short volatility. All that adds to the market volatility going down. So the vol of vol is worse. In other words, like, if we didn't have derivatives and it was just a plain old stock market, you know, maybe we wouldn't have crashed so violently, right? And I think that's kind of what you're alluding to, is like the vol of vol is so much higher because of, you know, the financialization of the market, or whatever you may want to call it. And you have to unwind these trades that are tried and true. I mean, that's what long-term capital management was, like the first major, one of the first major blowups, right? Of, you build this strategy that's based on these things that can never happen, right? And then suddenly something happens that makes that thing that never happened before, fire off, and then you're screwed. And so, you have a situation like, oh, I never thought Iran and that situation would get to this, where we are. And no one thought we were going to get a rate hike maybe. And suddenly we're facing a rate hike. And so again, it's those, you get these known unknowns that force these cover trades. And it unwinds these reflexive flows that have built up. So, in a way I can understand what you're saying. And I think there are some parallels.
So getting this next slide, you're getting more evidence of how low volatility was.
Yeah. And so a few slides ago, we talked about the S&P global slides on dispersion, correlation, volatility. These slides here, this is 3-month correlation. This is the SIBO measure. And all you can see, this was March OPEX, that low basically, right? And so again, what happens now, because of the environment we're in, all stocks are going down, right? Nothing is safe because people are selling equities. They want protection, whatever it is. So correlation stats higher. And look, this is a baby moving correlation compared to March of 2020, where everything went down, right? We're just sort of unwinding some things now. And to this also, we had very, very low volatility. This is the volley index, which measures 1-month spider volley volatility. And it's obviously it's spiking here now, but that all those flows that were into March, these consistent flows on, correlations going down, volatility is going down. That's all unwinding. And that's what these charts are highlighting. And I don't see a reason for this to go, back in the bag at this moment, right? Because what's going to happen is if the market bounces now, all stocks are going to go up, which is going to keep correlation high in for at least the next couple of weeks, you would think, right? Because, okay, there's peace in the Middle East or whatever it is. And so all stocks are going to go up. It's not going to be the same chip sector chase. I mean, chips are going to do well, obviously. But all stocks will go up, and that drives correlation up. So, same thing with volatility. Volatility is likely to remain somewhat elevated because I think if we do bounce in this situation, we could have a pretty, good substantial bounce. So again, it's about breaking some of those flows that were so persistent in the past. This was a fascinating slide. I actually just hit my inbox this morning. We, in the vol suppression slide, talked about how low vol was across assets. So if you look at oil and gold and credit, but and you can see here right into March options expiration. I'm not saying that March options expiration was the trigger for global cross asset vol to break out. It just happened to line up with that suddenly now you see gold vol going crazy. I mean, gold was going nuts the last couple of days, all-time highs. And now you can see these other assets reflecting higher levels of vol. And then down here again is the chart of the highest VIX options volume since, ironically, Volmageddon. So, this is, again, to my point, there's a lot of unwind going on now. Things are shifting. I think the period of relative calm that we've all enjoyed for some time, is certainly, I don't think we're going to go back to those lows of volatility is what the point is.
Yeah, it's interesting because we did have a period for a long time, like, I don't know, a year or two ago, where the move index was really, really high, but the VIX was low. So you were seeing a lot of volatility in the rate space, but you were not seeing a lot of volatility in the equity market.
100%. And the move index, which measures treasury bond volatility, it went under 100 for the first time, I think, since early 2022. It's now back above 100. It popped quite a bit off of essentially what we're looking at on your screen here. This week with the CPI printing hot, this is the 5-year treasury bond, the one-day trade, one-day change. And this was the biggest one-day change since March of 2020. So to your point on rate volatility, it went crazy. And honestly, I thought, and I wrote in the founder's note, that would transmit or would sort of make its way into the equity volatility space. But initially, the equity market just kind of ignored that, that treasury market volatility. And so, that rate vol cannot be ignored by equities, I would argue, for all that long. And I don't know if that rate vol is going to pause now or cool off. I think we're still thinking there's one more hike of what people are pricing in. And who's to say if that works out or not? But, maybe things subside a little bit. I don't know how war would impact those. The other thing that I thought was interesting is that if you look at seasonality, this is, I think this is from Morgan Stanley's chart on the right. Tax day, is today, the 15th. people had to maybe shift a lot of equity and other asset positions late last week, which I was flagging and a couple other people started to talk about as well. That could be a reason that there was initial weakness on Friday or extra volatility on Friday because people had to, hey, I got to sell my Bitcoin or gold because they took interesting dumps or just have to sell my stock to pay my tax bill. So seasonality wise, maybe this was also some of the trigger of some of the recent volatility. Now today, the headlines with Israel and their response to Iran certainly added to the mix. But I thought that, it's another signal that, hey, Iran is not in the geopolitical situation, not the only thing on the docket here. You do have a lot of shifts or other things happening under the hood.
Yeah. And also the election, you could argue that a lot of people have interest in driving the stock market up, coming into the election year. So that's something kind of on the other side. You've got positive seasonality, and typically, at least in these election years, you get a decent run, into election day.
Yeah. And I think, there's this very interesting intersection now between, inflation and, gold breaking out. I think it brought it. Why is gold breaking out, right? Why did gold vol finally start to move up? I think that, watching vol is very helpful for trading commodities as well. And gold vol started to move up. And Bitcoin has really been pretty stable, honestly, through this last couple of weeks. And so, the general idea is that, is there a paradigm shift here in terms of people not necessarily having a lot of faith in our fiscal and monetary policy, right? And the reason that gets interesting to me is because we've seen this last year, bid for call options and the right tail and all that kind of thing. And I don't think war is great for inflation. I haven't studied this in the past, but I do think that at some point, this idea of market of vol up, people really start to have to watch that and paying a lot of attention to that, right? And so, these are bigger macro things. We can ask a lot of people on our charity day on April 30th that comes up. But there's a lot of people that are talking about that. And so I think when you watch these shifts in rates and think about how it pertains to equities, the reason that I really pay attention to it now is because if you can't use bonds to hedge equities anymore, because that correlation is broken, right? In other words, you used to be able to own bonds to hedge out your equities, right? The 60-40 portfolio, this is something a lot better than I do. And now with rates possibly going higher, you can't really hedge your equity portfolio with bonds the same way that we were before all these rate shifts changed. My long-winded point about this is that arguably the only place to start to hedge your equity portfolio would be with volatility, right? And if credit markets start to get weak, you have to own volatility. If the right tail comes into place, you need to own right tail volatility. If the equity market's going to crap out because of the geopolitical situation, you need to own volatility, right? And so that is the common theme that keeps coming up for me, that, okay, we were waiting for this trigger to maybe unwind some of these vol suppression flows. And now you're starting to see all of these reasons that you want to own kind of that optionality, right? Whether it's right tail or left tail or whatever it may be. I think that the focus on volatility writ large is going to be something that a lot more investors are paying attention to.
Yeah. And you mentioned it, so I should just bring it up because I should have brought it up at the beginning. Like our charity day, April 30th. It's something we're really excited about. We're going to do it together. Spot Gamma and Excess Returns. We're going to have some great guests. You and I are going to, for the most part, from 8 a.m. to 8 p.m., be doing 30-minute interviews all day. We've got Jem Kersan, we've got Mike Green, we've got people in options experts, we've got people in value investing, we've got macro experts. We've got a really good docket, and it's going to be a lot of fun. And there is a placeholder, I believe, on both channels now for this. So if you on the Spot Gamma channel or on the Excess Returns channel, you can go click the little remind me button and be alerted when it comes out. And we're really excited to do it.
Yeah, absolutely. I can't wait. And it's great. You have so much street cred, so you can line up a lot of these great people to come and talk. And I think we're the first people to do this kind of charity day, long form stream of interviews. And, fortunately we're getting wild markets, right? Which if you want to have a bunch of people to talk about stuff, this is the kind of market you like to have where there's a lot of interesting things to discuss. So really looking forward to that.
Yeah, and before the day before the Fed too. So we will definitely, regardless of what's happening, whether the markets are volatile or calm, we're going to have plenty to talk about.
That's exactly right.
On the next slide here, you're talking about the vol space unwind / cover. So what are you getting at here?
Yeah, this here was just showing the VIX roll that we alluded to before. you can see these are the April contracts, so they expire in 2 days. There's a lot of positions getting closed, and you could see more time I've mentioned it was the record VIX options volume, but because it was a roll, it incrementally wasn't all that much new call open interest, I would say. So the idea here is just simply that, so this whole theme of that vol suppression trade may be coming to an end in a lot of ways, or at least being delayed or pushed back. I think it's a really interesting one, and it's going to be the theme, I think, from April into May options expiration, kind of, long volatility as a defaulted position as opposed to short vol.
And with the VIX expiration before OPEX, we've talked about that in the past. Like that does tend to increase risk a little bit, right? And does that play into the fact that there's also like a lot of VIX volume right now? I mean, do those things together create a little more risk in this situation?
Well, what we saw a lot of times what happened in 2022 when the VIX was just sustained at a very elevated level is you would get these very bizarre head scratching rallies, particularly on the Tuesday before options expiration, which is tomorrow. And I think a lot of that would be because people are monetizing their VIX call positions or just their vol positions writ large, right? Yes, it's VIX expiration, but there's a lot of other, like VIX futures are tied to that, which links into the S&P 500 options complex. So that's when positions start to shift and adjust. And I think when you have extra high volatility, like we do now, we have extra high vol relative to what we've had, that will get sold as positions get rolled out. And when that happens, I think you can get this weird sneaky bid. And it was funny because we were talking about this in the last VIX expiration. There was a guy on CNBC. He's like, I just can't explain this move. Like, it just doesn't make any sense, And like, well, if you knew it was VIX options expiration that this happens, like you can kind of time that a lot. And so, I think that tomorrow we could see a little bit of that. But once those VIX positions are rolled, then, it happens before OPEX, then there's not that same stability. There's not that same stable flow that is offered, possibly going forward. So it's often referred to as this window of weakness around options expiration and VIX expiration. And in this case, because VIX expiration is before equity options expiration, then, you have this period of shift to shift, right? Starting on Wednesday to Friday, as opposed to when VIX expiration happens after OPEX, then you'd have a Friday to Wednesday window. Now, what's interesting again here, obviously, is that vol is pretty high going into this event. So I do think that the clearing of these volatility positions, assuming that there's even just a slight pause in some of the just rhetoric or whatever the situation may be, geopolitically, you could have a pretty substantial relief rally just on the adjustment of these positions. So in this case, I think options expiration flows could be supportive over the next week, which could lead to a pretty strong and rapid recovery.
So what are we looking at in this next slide here, the volatility cover?
Yeah. And what this shows is basically long dated. And I say long dated, it's funny because now long dated is 2 months out. It used to be a lot of people would own 1 year of volatility. But so what this shows is yellow is the 2 month S&P skew from 2 weeks ago. So this is April 1st. And you can see that where the yellow line is the bottom of the shaded cone. The shaded cone is statistically the 90-day range. And so, we were 2 weeks ago at the bottom of the range, and the range was during a very quiet market period, just writ large. So now we see to this point of hedging known unknowns. This morning, we see that there's a big lift in that longer dated skew, which is simply telling us that people are hedging out longer dated risks now, right? And to your point before, we're far from the election, but we're not that far from the election. And so we have this period of volatility now. Certainly Powell's going to adjust some rate expectations with FOMC coming up in a couple of weeks. Then the rhetoric around elections are going to pick up. And that's if the geopolitical situation just sort of like totally cools off in the next couple of days, which I don't know that anyone thinks there's a short-term solution to that. So this idea that the vol is going to be out of the bag right now seems more reasonable when you start to think about the fact that geopolitics aren't cooling off. We're not sure about what's going to happen monetarily. And then there's always hedging around the election, right? There's always a vol bid into elections. It's just the way that things work. So I wouldn't expect this year to be any different.
Yeah, I was just thinking when you're saying that, we've got a serious game of three-dimensional chess going on right now. You got the geopolitics, you got how Powell reacts to it, you've got the election. There's a lot of moving parts here that can go in a lot of different directions.
Yeah. And I think, it's a weird situation. Powell or Biden saying, we're going to get a rate cut, and I've never paid so much attention to rates in my life, but now you have to pay attention to rates if you're, an options trader, an equity options trader, because, there's such a linkage there. So, there's just, to your point, all these dynamics at work. especially into this election cycle, which makes things even a little bit more challenging. So no rest for the weary here, I think, over the next couple of months.
And so on this last slide, you're just getting some more evidence on this volatility cover.
Yeah, and the reason I wanted to end with this is that, VIX here is indeed threatening 20, but if you look at where we've been over the last post-March of 2000 and the COVID crash, this is an unprecedented level of calm, right? And it seems like we're starting to lift off of these lows of 2023 and 2024, and to have a sustained environment with the VIX around 20 is not all of that crazy. And that's why I wanted to end with this. I don't know that we have a record spike. The sort of recent high, if you look at 2022, was an intraday VIX spike to about 38, 39. And that was before the Russian-Ukraine war kicked off in February of 22. And so, there's precedent for volatility to really shift quite a bit higher. And I think that, hey, VIX 18, that's pretty high. That's, it's a lot. It is high in the context of the last year. But if you zoom out a little bit, there's plenty of reason to think that we could be living kind of in a little bit of a different vol regime over the next several months.
So to summarize, you don't think the vol of the VIX of 13, you probably don't think we're going to see that for a little while.
I mean, if indeed we're starting to cover a lot of these flows and shifting the paradigm a little bit from, focusing on zero DTE, and there's this big call, hedging flows that are in the market, and some of that is now worn away, and people are worried about hedging with volatility and kind of the idea of like Vega is this flow that matters again. Then I do think that, we could be living in this more sustained environment where, VIX of 16, which implies 1% daily S&P moves, becomes a little bit more of the norm as opposed to something down in the 12 to 13s.
So we got a comment on the last episode that all the content was excellent, but that we were too long-winded and went on for too long. So the good news is 46 minutes this time. We heard your feedback. We've answered it. We're going to be shorter. And thank everybody for joining us, and we'll see you next time.
Thanks, Jack.
This is Justin again. Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
The opinions expressed in this podcast do not necessarily reflect the opinions of Volatility Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital.